Let me ask you something. You've been watching Bitcoin, you've seen the headlines. BlackRock's ETF crossed $50 billion in assets faster than any ETF in Wall Street history. Sovereign wealth funds from Abu Dhabi are quietly buying in. Corporate treasuries are now treating Bitcoin like a reserve asset. The US government floated the idea of a strategic Bitcoin reserve. And yet, the price action over the past several months has felt broken. All-time highs, then a slow grind down, then sideways, then another drop. And you're sitting there thinking, with all of this money supposedly pouring in, why does it feel like the price is being held underwater? Here's what I've spent the last several weeks digging into. And what I've found is not a conspiracy theory. It's not some shadowy backroom deal. It's a completely legal, openly documented trading structure that has been verified by SEC filings, CFTC data, and institutional research reports. And almost nobody in the retail investing world understands it exists. It's called the basis trade. And by the time this video is over, you're going to understand exactly how it works, why it was designed, who benefits from it, and most importantly, what it means for the price of Bitcoin that you're holding right now. I analyze financial structures for a living, and if you've ever wondered why Bitcoin seems to move in ways that defy the adoption story, stick with me, because we're about to go deep. The illusion of institutional demand. Let's start with the number everyone keeps citing. By late 2025, U.S. spot Bitcoin ETFs had accumulated over $114 billion in total assets under management. BlackRock's IBIT ETF alone held somewhere between 780,000 and 800,000 Bitcoin, more than Strategy, the company formerly known as MicroStrategy, which had spent years and billions of dollars accumulating its position. On the surface, that sounds like a tidal wave of institutional money flooding into Bitcoin, and headlines everywhere were screaming about it. Institutional adoption has arrived. Wall Street is buying Bitcoin. The dam has broken. But here's the question nobody was asking. Who exactly was doing the buying and why? Because when researchers at CoinShares dug into the actual SEC 13F filings, the legal disclosures that institutions with over 100 million under management must file every quarter, what they found was quietly devastating to the narrative. Hedge funds, which had made up roughly 41% of all 13F Bitcoin ETF assets in Q4 2024, cut that exposure by nearly 1/3 in Q1 2025 alone. That's a massive reduction, and it happened during a period when the overall ETF market was still widely described as a bullish signal for the asset. So what were hedge funds actually doing in those ETFs? Why did they pour in and then cut back? The answer requires understanding a financial mechanism that has been operating in broad daylight, but that almost no retail investor has ever heard of. The basis trade. What it is and why it matters. Let me explain the basis trade from the ground up. I want you to actually understand this because it changes everything about how you interpret Bitcoin price movements. When you buy a Bitcoin ETF like IBIT or FBTC, you are buying a share that represents ownership of real Bitcoin held in a vault. The ETF price tracks the spot price of Bitcoin, the price you'd pay if you bought Bitcoin directly on an exchange right now. Now, separately, on the Chicago Mercantile Exchange, the CME, you can buy or sell Bitcoin futures contracts. These are agreements to buy or sell Bitcoin at a set price on a specific future date. Here's where it gets interesting. Historically, the futures price of Bitcoin tends to trade above the spot price. If Bitcoin is at $100,000 today, a futures contract expiring in a month might trade at $102,000. That gap, that premium, is called the basis or the basis spread. Hedge funds have been exploiting this gap through a strategy where they purchase Bitcoin ETF shares at the lower spot price while simultaneously shorting CME Bitcoin futures contracts at the higher futures price. As those futures contracts approach expiration, the gap between spot and futures prices naturally compresses. The funds then close both positions, selling the ETF shares and buying back the futures, and pocket the difference. This is the basis trade. And the critical thing to understand is that it is completely market neutral. The hedge fund does not care whether Bitcoin goes up or down. They are not making a bullish or bearish bet. They are harvesting the mechanical spread between two prices that must eventually converge. As one forensic analysis put it, the same institutions that appear as buyers in ETF flow data simultaneously appear as sellers in the futures market. The net economic exposure is zero. The net contribution to price support is zero. Let that sink in for a moment. When you see a headline that says hedge funds bought $5 billion in Bitcoin ETFs, a significant portion of that buying came paired with an equal short position in futures. The net effect on Bitcoin's price? Zero, possibly negative, because the short leg of the trade adds downward pressure to the futures market. This is the first crack in the institutional demand narrative. The numbers don't lie. Let me show you how this plays out in the actual data, because this isn't theoretical. According to CFTC positioning data analyzed in detail by market researchers, leveraged funds, the category that includes hedge funds and proprietary trading desks, held approximately 15,399 short contracts against just 3,003 long contracts on the CME Bitcoin futures at the height of institutional ETF buying. That is a 5-to-1 short-to-long ratio, 5 shorts for every 1 long from the institutions everyone thought were bullish on Bitcoin. CME Bitcoin open interest climbed from roughly 30,000 contracts in early 2024 to a record near 45,000 by late November 2024. And this expansion in positioning coincided precisely with a widening of the annualized basis, which at points exceeded 20%. At 20% annualized, this trade was generating returns that rival the best-performing hedge funds on Wall Street, with essentially no directional risk. No wonder they were piling in. The trade was straightforward. Buy spot Bitcoin ETFs while simultaneously shorting Bitcoin futures on the CME, capturing the spread between the two prices. No Bitcoin price view required. Just pocket the carry yield. And when did this trade start unwinding? When the spread compressed. When the annualized basis dropped from the high teens down toward 4 or 5%, the trade was no longer attractive enough to justify the capital allocation. When the annualized basis compressed from 6.63% to 4.46% in late 2025, roughly $4 billion in ETF redemptions followed over 53 days. $4 billion out. Not because anyone turned bearish on Bitcoin, not because the technology failed, not because adoption slowed, simply because an arbitrage spread became too thin to be worth running the trade. And here's what that selling pressure looks like to a retail investor watching their portfolio. It looks like Bitcoin dropping for no reason. It looks like the institutions that were buying in suddenly disappearing. It confirms every fear and every doubt. But the reality is far more mechanical and less emotional than that. The great exit of 2025 and what triggered it. Bitcoin hit an all-time high above $126,000 in October 2025, and hedge funds got in first and got out first. The data from Q4 2025 is stark. Institutional investors reduced their Bitcoin ETF exposure by the equivalent of roughly 25,000 Bitcoin during that single quarter, valued at approximately $1.6 billion at early 2026 prices. Brevin Howard alone slashed its position in BlackRock's IBIT from 36.7 million shares at peak to just 5.5 million by year-end, an 86% reduction. D.E. Shaw, Farallon Capital, Schoenfeld Capital, Sculptor Capital, and Symmetry Investments all cut hard or vanished from the top holders list entirely. Why? Because their trade had worked perfectly. They bought the ETF at lower prices, shorted futures at a premium, the basis compressed during the rally, and they closed the trade at a profit. Mission accomplished. Exit stage left. Unlike the forced liquidation seen in previous crypto cycles, this was mostly voluntary de-risking. Long-term holders, including some corporates and governments, absorbed much of the pressure. So who was buying while the hedge funds were selling? Longer-term capital. Sovereign wealth funds, registered investment advisors, and retail investors coming through financial planners. The Abu Dhabi Sovereign Wealth Fund's investment arms both increased their IBIT positions, bringing their combined holdings north of $1 billion. This is the fundamental dynamic of modern Bitcoin markets that almost nobody is talking about. Fast money cycles through using arbitrage strategies, extracts yield, exits, and leaves the asset to longer-term holders, often at prices elevated by the very momentum those strategies helped create. Strategies trap, a different angle. Now let's talk about strategy, formerly MicroStrategy, because there's a separate structural pressure operating here that compounds everything we've discussed. Strategy has built the largest corporate Bitcoin position in history by financing it with debt, convertible bonds, and preferred equity. With over 671,000 Bitcoin financed through these instruments, the company functions more like a a high-beta Bitcoin fund than a traditional operating business. Here's what makes this structure uniquely fragile. Strategy has issued approximately $8.2 billion in convertible senior notes with a weighted average coupon of just 0.421%. Several tranches carry a 0% coupon, meaning bondholders receive zero interest payments. Why would anyone lend money at 0% interest? Because the bonds come with a conversion option, the right to swap debt for equity at a predetermined price. And with MSTR's extreme volatility, that embedded optionality is enormously valuable. The 30-day implied volatility on MSTR sits around 106 compared to roughly 15 for the S&P 500 and 60 for Bitcoin itself. So hedge funds buying these zero-coupon bonds aren't doing it out of charity. They're buying optionality, and they hedge that optionality by shorting the stock, which creates a persistent downward pressure on MSTR's price share. And when MSTR's price share moves, it affects perceptions of Bitcoin's stability. The mechanics get even more interesting when you look at the put options embedded in some of Strategy's debt. Holders of the 2029 and 2030 zero-coupon notes carry put options allowing them to force repurchase in mid-2028. If MSTR's stock remains below the conversion prices at that point, bondholders will exercise those puts, and Strategy will need to find billions in cash or roll the debt at potentially much higher rates. This isn't a time bomb, it's a pressure cooker with a specific release date, and sophisticated investors who understand the mechanics are positioning accordingly. Strategy's total obligations, debt plus preferred stock, amount to approximately $15.993 billion. The company's preferred equity carries a BTC rating of 3.6x, indicating a thinner collateral cushion relative to its convertible debt stack. A 3.6x coverage ratio sounds fine in a stable market, but Bitcoin is not a stable market. A 40% drop in Bitcoin prices, the kind of move that has happened multiple times in Bitcoin's history, cuts that coverage ratio significantly and starts raising real questions about the company's ability to service its obligations without liquidating holdings. The wealth transfer mechanism. Here's what I want you to understand about how all of this comes together. The basis trade, Strategy's convertible bond structure, the hedge fund short positions in both MSTR stock and CME futures. None of this is coordinated conspiracy, but it doesn't need to be coordinated to have a coordinated effect. Each participant is rationally pursuing their own financial interest. The hedge fund running the basis trade wants to harvest the spread. The convertible bond buyer wants the optionality. The short seller wants to hedge their delta. And the retail investor in the middle of all of this sees price going down, adoption narrative going up, and complete confusion about why those two things don't match. While institutional ETF buying generated massive headlines, retail investors sold roughly 247,000 Bitcoin during 2025. 247,000 Bitcoin sold by retail. Absorbed by whom? By the longer-term institutional holders, the sovereign wealth funds, the advisors accumulating for clients. Corporate entities alone acquired $54 billion of Bitcoin in 2025. These holders are generally considered less likely to sell rapidly than individual retail investors, which could provide price support going forward. The transfer is happening in slow motion. Retail sells during volatile periods. Institutional capital absorbs. The asset continues to mature, and the people who understood the mechanical pressure, rather than panicking about it, positioned themselves on the right side of that transfer. This is how wealth moves between generations of market participants, not through fraud, not through force, through information asymmetry, mechanical complexity, and the psychological difficulty of holding through manufactured volatility. What changes everything and when? Now, I want to give you something actionable here, because understanding a problem is only useful if it changes how you behave. The basis trade works when the spread between spot and futures prices is wide enough to justify the capital allocation. When that spread compresses, either because too many traders are doing the same trade or because Bitcoin's price momentum stalls, the trade becomes unprofitable. Hedge funds unwind. ETF selling hits the tape. Price drops. But here's what that unwinding also does. It removes the artificial short pressure from the futures market. When those hedge funds close their short futures positions, they buy them back. And buying futures creates upward price pressure. If the basis spread narrows enough to trigger a wave of position closures, the short covering could potentially trigger a short squeeze, a rapid upward movement as funds scramble to close their positions simultaneously. The setup for the next major leg higher in Bitcoin might not be driven by new retail enthusiasm or another company announcing a Bitcoin treasury strategy. It might be driven by the mechanical unwinding of the very trade that suppressed the price on the way down. Watch three things. First, the CME futures basis spread. When it starts widening again after a period of compression, that's a signal that the basis trade is being re-entered, which means new ETF buying is coming, even if it's not real demand. Second, the 13F filings each quarter, specifically whether the ratio of hedge fund holdings is increasing or decreasing relative to longer-term holders like advisors and sovereign funds. A rising share of long-term holders is structurally bullish. Third, strategies' quarterly disclosures, specifically their cash position and their BTC rating metric, which tells you how much buffer they have before Bitcoin price pressure starts threatening their capital structure.